Welcome to Thrive Live broadcast. We're so excited that you joined us again this Tuesday at 2. We have some really exciting news to share with you. We're going to be talking about the R word today, as maybe you guys have noticed on some of the advertisements, but we're really excited to bring you news that's current in the industry and to share with you what that means for you as a professional or as a consumer today. If you haven't already, please subscribe to our channel and hit the bell so you can be notified when we drop new content. Now, our host today to bring you the mortgage news is Michael. Thanks for joining us. Welcome.
Yeah, well, thanks for having me. I'm always happy to be here.
Very good. So what can you share with us that's going on in the news?
Yeah, absolutely. Well, and I'll give just a brief introduction. So I'm Michael Jones. I'm the CFO here at Thrive Mortgage. And before I got to become our CFO, I was also an originator out there in the Dallas market, just trying to help my clients save money by refinancing and also pick the best loan product that they could for their financial situation. So that helped me to really appreciate just what it looks like to have these conversations with a borrower, with a referral partner like a realtor or financial planner. And I think the word that we can use for this year is volatile. It has been an incredibly volatile year. If we look back, we've seen the highest rate increases really ever. And you have to go back to the early 1980s to discover that to be the case. And so whether you're talking about the 10-year Treasury, which helps to drive mortgage rates, or if you're talking about a 30-year fixed mortgage, we've seen the amount of increase the highest it's ever been. Now, certainly rates aren't the highest they've ever been. We were in the 15% range at some point back in the 70s and 80s, but this is a little bit unprecedented for our current market because of where home prices have gone. And if you owned a home prior to 2020, you've really gotten a substantial benefit as compared to trying to buy a home now, because there's been about a 40% over the last 2 years, so about a 20% year over year during 2020, 2021, and we're kind of seeing that cool off in 2022. So all that to say, it makes it a little bit harder to get into those homes with those higher interest rates. But, one of the questions I know I always wondered whenever I was a loan officer, and also as I was working with my consumers, is just what in the world is driving these rates? What determines a rate and what determines my rate? And so one of the key drivers to what determines a rate for mortgages is what is going on with other financial instruments out there. And a financial instrument is going to be things like a stock, a bond, debt, that sort of thing. And so the 10-year Treasury has been a really good benchmark for years because it tends to mirror what the prepay speeds on a mortgage is, meaning a homeowner stays in their home for 4, 7, 10 years. And so that's kind of a good gauge and metric. And so one of the things that mortgage rates have to do is they have to outstrip the 10-year Treasury, because the 10-year Treasury is considered risk-free. The U.S. government has never defaulted on its debt. It's probably never going to default on its debt. And so if an investor, a large institution, like a government or a pension fund or something like that, is going to choose to invest in mortgages, they have to get enough of a return that it's worth their time. And so that's why we may see mortgage rates be at 5, 6, 7%, and we may see the 10-year Treasury in the high 3s, the 4s, because there has to be that additional amount of, we'll call it risk premium, in order for them to feel comfortable investing in that mortgage, that bond. And so that's one of the primary drivers and why we've seen, as inflation has gone up, as the Fed has increased rates, as the 10-year Treasury has gone up, all those things have caused mortgage rates to increase. And then, of course, there's individual loan level characteristics that can drive it. If you have a lower FICO, tend to have a higher rate because of that risk of not paying, or just people don't know what your payment history is if you're a new borrower, new to credit. So those types of things can influence mortgage rates.
Yeah, very good. So how do you feel? We saw a little bit of a drop this week. So do you think that's here to stay? What's your prediction on?
Yeah, it's funny. All the experts coming into this year predicted that we would be in the upper 4s. I think a couple were very outlandish and said we might be in the low 5s. And so everybody's been wrong all year long as to where interest rates are going to go. So I'll offer an opinion, but it's almost certainly wrong, just as everybody else's has been wrong. I do think we've kind of entered a band here between where we've peaked, which so far has been about 7.25%, give or take, on mortgage rates for a 30-year fixed loan, and now we've dropped down to somewhere around 6.5%, give or take. And I think given the relative unknown Are we heading into a recession or not? Has inflation peaked or not? Is the Fed going to continue increasing or not? There's just so much unknown out there that it's hard for anybody to make a determination. I would feel comfortable saying mortgages are at least stable at this level in terms of mortgage rates, or stable at this level. But in order for us to see rates go down, we would need to see the Fed very convincingly say, hey, we're done increasing rates, which would cause investors to not have to seek a higher rate alternative to try to outstrip inflation, or we would actually have to see there be meaningful signs of a recession, at which point the Fed may come in and offer some of their easing that they do, because they have to have low inflation and they also have to have strong employment, and we really haven't seen that employment number suffer yet. Yeah.
So how do you feel, this fluctuation, like you said, just volatile industry, how does that affect the consumer? Do you have any advice? Some people can say, I'll wait or see what happens, but other people have to move right now. They're in whatever situation. What kind of advice do you have for the consumer in this industry?
Yeah. I know a lot of people will look at prices over time and they may say, oh, there's a bubble. I certainly don't want to buy a home now because I don't want to get left holding the bag. And I think there are some markets that are going to be a little bit more sensitive than others. And we all know those major metros where it's just kind of a hot place to live. I would be careful, right? Because those are probably going to have the biggest pullback. But if you're looking at more of just the suburbs, if you're looking at some of those major metros, like Dallas is a good example, really hasn't seen just an insane run up in prices. It's been kind of a healthy run up. Then the long-term trajectory of home prices going back past the great financial crisis, going back 20, 30, 40 years, has been an ever-increasing march higher. Just in the state of Texas, I know that prices have gone up, I believe, 200% since the year 2000. And it was just incremental. They would increase 4, 5, 6% per year, and that was very healthy and expected. So I think all that to say, I wouldn't be afraid of just a price drop. And really one of the biggest reasons for that is there is simply not enough housing inventory out there for the number of people that want to move into houses. We have the millennial generation. The millennials are huge. They have a lot of demand to move into homes. Oddly enough, people enjoy having kids in homes relative to maybe apartments that are a little bit smaller, that don't have an outdoor, that don't give you a little bit more space so that you can have some freedom. And so all of those things are causing home prices to stay pretty stable and even to increase higher. Right now, I think we have just over 1 million homes in inventory, and we need substantially more than that. And because rates are higher and because there is a little bit of uncertainty, people are not just flocking to list their homes and move and sell. So all of that is going to cause home prices to stay, somewhat high.
Yeah, great advice. What about folks who are in the industry?
Yeah, folks in the industry, obviously it's important to keep marketing, and it's important to keep, mining your referral basis. And one of the things that we couldn't do with COVID was get out into the public and actually start making those new connections. Strategies that involve getting ahead of homeowners thinking about moving is important. It's important to start talking to people that are renting apartments, making sure that they're home purchase ready if they need to work on things for credit, if they need to source a down payment. There are a lot of things that can be done, especially in this winter months, is people don't necessarily want to move around the holidays. They want to just enjoy the holidays and kind of chill out, especially with temperatures coming down across the United States. So I think professionals can just make sure that their clients and prospects are purchase ready, and that involves conversations, and that involves pre-qualification and that sort of thing.
Absolutely. That was one of the, I think, reasons we started this broadcast, was to get the word out there. A lot of people are seeing these headlines, and as a consumer, they're concerned. They don't know, should they move or should they sell their house or continue to rent or whatever. And so, education is so important. And that comes down to the industry professional to get out there and have those conversations and educate. So awesome. Well, we do have a question here. So we've got somebody that's wondering about adjustable rate mortgages. Are they worth considering right now?
Yeah, that's kind of been the question all year in 2022. It really depends, right? I don't think that we are possibly in a sustained long-term interest rate environment. meaning that historically, at least in the last, say, decade, the entire world, and the United States is not excluded from that, has become so debt dependent that in order to be debt dependent, you have to have low enough rates to service the debt. If the interest expense is too high, you simply cannot afford the debt and can't do it. And so I think for that reason, rates are bound to come down versus go ever higher. Now, again, everybody's been wrong for the last year, so who knows? We may have 10% rates. But as I look at it, ARMs are still only somewhere around 10% of the overall market, and typically those are going to be on those jumbo loans. Typically, those may be interest-only type products that are on ARMs, and so I think some of the misconception out in the industry is that ARMs have just taken over the world. It is nice to be able to say that you have a fixed payment that is not going to go up, and with an ARM that may change on you, and it may change at a very inopportune time. ARMs can also be difficult if you want to potentially depart that residence in the future and use it as a long-term rental, build an investment portfolio. So for all those reasons, I would say a fixed rate mortgage is usually in everybody's best interest. Yes, the interest rate may be a little bit higher on those right now, but there are ways to get around that. So you can buy down the rate. Thrive has 2-1 buy downs, which is a great opportunity to sort of ease your way into a payment over a few-year history. And then if rates do come down like we're all hoping, say a point, certainly I don't think we're going down to the 2s again, but if they go down, say a point, you can easily refinance that loan. You're still in the home that you love, but you get a little bit more desirable payment.
Great. So, if you're a consumer that maybe doesn't have a broad understanding of the mortgage industry in general, what are some of the questions you think you should be asking a loan officer to see what these programs are, an adjustable ARM rate or conventional fixed rate, like buying down your rate, like those types of things you were just talking about? What are the questions that you need to ask?
Yeah, no, great question. And as a consumer, you don't always think to ask these questions. And that's why it's important to do some research ahead of time. One of the things I think is really critical, and more people need to do it, is just sit back and think about what your goals are in life. One of the easiest ways to build a real estate investment portfolio that's safe and that can provide you value later in life is to buy a home and move from that home over time. And so as a consumer and as a loan officer, those are the kind of conversations you can get into. The consumer may say, hey, I want to spend forever in this home. I want to raise my family in this home. This is where I want them to come back and have Thanksgiving turkey. And that's great. And that's the mortgage solution that needs to be identified. If somebody says, hey, I don't know how long I'm going to be in this home and I probably only need to be here a few years, well, there's a very specific mortgage product for that. And that may be where they choose to start their real estate investment portfolio by moving from that home, turning it into a rental and buying the next one. And so when you have that conversation about what your goals are as a consumer, that really helps the loan officer guide you through this process because, getting quoted a rate and term and this is what your monthly payment's going to be is pretty simple, but it leaves out the very important conversation of like, what is it you're trying to achieve here? And so that's where I would spend the most time if I was a consumer, purchasing, making sure that loan met my needs.
Awesome. All right, we have one more question before we close out our broadcast today. So if Ashley says, I can't afford the house that I want in this market, so should she renew her apartment lease or look into renting a house until she can buy her first home?
Yeah. Honestly, moving into that home can be a great transition because if you move into the home, you get a feel for home ownership. You get a feel for what it's like to have that backyard, what it's like to be able to paint a room, assuming your landlord will let you do that. And so I would encourage folks, if they have that opportunity to move from the apartment to the home, typically homes, and I say typically here, are owned by individual investors, people that may only own a couple of homes. And so they don't have the same financial metrics and financial needs that a large syndication or a conglomerate needs, which often they achieve through apartments. And so if you're in an apartment, you may be at the mercy of a landlord, a syndication, somebody that has to hit a certain return for their investors. And so they'll increase rates over and over and over again. And you have, if you're one apartment renter amongst hundreds of apartment renters in the complex, you're the little person. You know, you're a small voice in the sea of voices. And so that's where, if you do have that opportunity, you'll have a little bit more control over your destiny. You can have conversations with the landlord if you're in a home. And in fact, I own a couple of homes, and I have chosen not to increase the rent for some folks because I know this is hard times, and I don't need to increase the rent to make the numbers work. So again, that's where there's some more flexibility on individual homes compared to apartments.
Nice. Okay, can we one more?
Yeah,
all right?
absolutely.
Okay.
Yeah.
All right, so do interest rates differ based on the loan program and term?
Yes, they do. And so interest rates, typically, if you're going to have a shorter term, meaning it takes less time to pay off that mortgage, like a 15-year versus a 30-year, typically speaking, there is a lower interest rate on that. We're in bizarro world in 2022, so that's not always the case the way that it has been for the last 30 years. But yes, if you have a shorter term, typically there's a lower interest rate on that. Government loans, which would be like an FHA, a VA, a USDA, those loans can have higher interest rates associated with them, partially because the end investor, the servicer, they have to try to offset the risk of default, delinquencies, that sort of thing. And those products are made for first-time homebuyers largely. Now, sometimes they're not. Like the VA loan is meant for a veteran, and those perform exceptionally well. But there can be some added cost to service loans. And so typically a government loan can have a higher rate than a conventional loan. The other thing that you also want to look at more is just the payment in general, because a conventional loan will have something called private mortgage insurance, and a government loan will have something called a mortgage insurance premium. And so they'll sound very similar, and they pretty much are, but conventional loans can have a lower amount of that insurance. So if you're looking at the overall payment versus just the interest rate, that's where you want to pay attention. What is my monthly outlay, not just what does the interest rate tell me?
Great. Well, thank you so much for joining us today. We got to learn a lot from you. We appreciate your time. And thank you guys for joining us on the Thrive Live broadcast. We wish you a very happy Thanksgiving, and we'll see you guys next Tuesday. Take care. Subscribe if you haven't already. Bye, guys.
Thank you.